Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, February 5th, and today's vibe is leverage got scared, bonds got popular, and big tech said, relax, we're spending more.
Nothing says relax like markets free-falling and executives announcing a bigger shopping cart. I brought emotional support cash. And by cash, I mean I looked at my bank app and sighed.
We'll break down 4 stories. Bitcoin slipping under 70,000, stocks down with bonds up on job cuts data, Alphabet selling off after an earnings beat because of higher AI spend, and oil dipping after Iran confirmed U.S. negotiations set for Friday.
So it's a full buffet: crypto pain, macro nerves, AI capex drama, and geopolitics with a side of crude. If anyone needs me, I'll be under a diversified index fund. Bitcoin at $69,858 sounds like a luxury car that immediately depreciates when you drive it off the blockchain. Also, everyone gets weird around key levels. It's like crypto has its own haunted house rules.
Here's the simple finance behind it. The phrase you'll see is forced deleveraging. Imagine you bought Bitcoin with borrowed money and the price drops. Your lender says, add cash or we sell your position. That automatic selling pushes the price down more, triggering more margin calls. It's a chain reaction.
So it's basically a group chat where everyone yells, "I'm fine," while simultaneously dumping their bags. And the group chat is run by math.
Why it matters for normal people. If you're in crypto directly, a break of a widely watched level can change short-term behavior. More stop losses, less dip buying. If you're not in crypto, it still leaks into tech sentiment and risk appetite because the same investors often hold both.
Actionable takeaway. If your plan is, I'll just hold forever, then stop checking the price every 6 minutes like it's a medical monitor. And if you're using leverage, maybe don't treat margin like it's free guac.
Story 2. Stocks fell and bonds rose after job cuts data revived worries about an economic slowdown. The market read it as, growth might be cooling, so investors rotated towards safety, meaning treasuries.
Bonds rising is the market putting on sweatpants. It's not glamorous, but it's comforting. Meanwhile, stocks are like, I swear I can still go out tonight.
The mechanics. When investors expect weaker growth, they often expect lower future interest rates. Bond prices move opposite yields, so demand for bonds can push yields down and prices up. At the same time, slower growth can mean lower corporate earnings, which pressures stock prices.
So the market is doing that thing where it's sad about the economy, but happy about the possibility of cheaper borrowing later. It's like being upset your car broke down, but thrilled you'll get steps in.
Story 3. Alphabet shares were down pre-market even after an earnings beat because the company said it would hugely increase AI spending in 2026. Markets often care less about last quarter's score and more about next year's bill.
This is the corporate version of, good news, I got a raise. Bad news, I immediately bought a boat. Investors are like, cool, but do we get to ride the boat?
Simple version of the finance. Higher AI capex, think chips, servers, power contracts, hits free cash flow now. The promise is productivity and new revenue later. The question investors ask is ROI timing. When do those data centers turn into durable profits, not just bigger depreciation?
Meanwhile, oil said, I'm going to calm down, which is rare. The headline, oil declined after Iran confirmed U.S. negotiations set for Friday, so the market priced a little less immediate risk of supply disruption.
Exactly. Think of oil as a product with a fear premium. If the probability of conflict or sanctions escalation drops, traders may remove some of that premium. That can pull prices down even if demand hasn't changed much overnight.
Recap for humans: crypto got margin called, stocks got nervous, bonds got cozy, Alphabet got expensive ambitions, and oil got slightly less dramatic. If you want a practical move, know your risk. Don't confuse popular narrative with portfolio plan, and maybe keep an eye on cash flow when companies promise the AI future.
If you found this useful, subscribe and share BD Daily Finance News Podcast. Tomorrow, we'll follow whether the risk-off move sticks. Watch Bitcoin's reaction around that $70,000 area, bond yields versus growth data, and how markets digest AI capex guidance. See you next episode.